Gold. Some people love it, others hate it. It's the third rail of investing. But we're going to risk getting burned today. Join me, Jeff DeMaso, and Josh Jurbala for a level headed look at the polarizing metal. Hello, and welcome to another Advisor You Can Talk To podcast. I'm Jeff DeMaso, Director of Research at Advisor Investments. And today I'm joined by my colleague Josh Jurbala, our Quantitative Investments Manager. In English, that means Josh leads our tactical strategies. Josh, welcome to the podcast.
Hey Jeff, good to be here. Let's talk some gold.
Yeah, gold indeed. Gold is the third rail of investing. So we're choosing a meaty topic for your inaugural Advisor You Can Talk To podcast. All right, why is gold so? Why am I calling it the third rail? Why is it so incredibly polarizing? It's that there's diehard gold bugs, and there's other people who dismiss gold as a pet rock. And coming down on either side can lead people to just dismiss you offhand. And while we do want to come down and have an opinion on gold, we know that emotion is the enemy of sound judgment. So, Josh, I think what we want to do here is let's try and keep emotion out of the picture as we talk a bit about gold today. We can provide some of the basics on gold, review both the bull and bear cases, dig into what's happening, and then try and sum it all up with our view on gold. But let's try and provide a bit of level-headed education first. How's that sound?
Yeah, sounds great to me. As you said, I run tactical quantitative strategies and I love to keep emotion out of things, so let's do it.
All right, perfect. Okay, let's maybe start with what is gold, and importantly, why is everyone, including the two of us, talking about it today?
Yeah, sure. So, gold is a precious metal. It's been around for centuries and it's been used in jewelry and technology as a currency and store of value in coins and gold bars. And it's also traded as a commodity and it's invested in as a diversifying asset for investors to hedge against global risks and possible inflation. Um, so, as to why we're talking about it, the short answer is that gold's up over 30% this year. And investors see those big returns and they want to know if they should buy in.
Yeah, I can see why 30% might get some headlines. Um, we'll dig into it into detail, but maybe just give me the quick and dirty answer of why is gold up 30% this year?
Yeah, sure. So we'll get into this, but gold is up because the narrative behind it's hitting on all cylinders this year, which is driving investors to buy gold in droves. That narrative is based on three themes. The first is safety, and investors are just looking for safe havens or assets to protect their portfolio from global risks. And the second theme is opportunity cost. That's because typical safe havens like US Treasuries are yielding so little these days, investors don't want to just hold bonds or cash. And that third theme is inflation. Investors view gold as an inflation hedge and store of value. They see unprecedented monetary stimulus from central banks, and they just anticipate inflation increasing, so they think gold is a hedge against that.
All right, let me pull on that value idea or store of value idea. More fundamentally, ignoring what's going on today, maybe, but like what makes gold valuable or unique?
Yeah, gold's very unique because it plays a dual role as a commodity and a currency. As a commodity, it gets value from its use as a raw material to meet fundamental needs like jewelry making or to make small parts in technology. And then that other use is a currency, where gold's a medium of exchange, and it's viewed as a possible safe haven or and store of value. So that's currency store of value theme is why most investors are interested in gold, and that's why we'll focus mostly on that theme today.
Okay, so gold, historically has been a currency and it's got some
hmm
uses, as a commodity. Um, that seems kind of simple, I guess, but why is it so difficult and polarizing? Why is it hard to allocate to?
Yeah, I mean, I think the first reason you kind of went over in the introduction, it's a polarizing subject, so it's hard to get unbiased information on gold. People are either staunchly gold bugs or staunchly gold bears. It's hard to kind of get a moderate take on it. And then the other kind of difficulty with gold is just its complexity. There's so many drivers affecting the price of gold, and sometimes those drivers conflict with each other. For instance, I mentioned that inflation's a tailwind for gold, or a positive driver for gold price. Well, economic growth can lead to inflation, and if the economy improves, that kind of offsets the need for safe havens in the first place. So, just that complexity, those kind of conflicted drivers, and the fact that gold is just a global asset and trades at a lot of different currencies, it just makes it kind of hard to wrap your head around sometimes. And I think that's why we wanted to talk about it, because, it's not the slam dunk investment people are saying it is these days.
Yeah, it's an interesting point that those narratives sometimes can conflict almost,
Hmm.
as you point out with inflation there. Okay, we talked. We've both mentioned gold bugs and gold bears. Let's take them in turn. Maybe talk to me about what is that bull or gold bug in the parlance case for gold. What's the argument of buying gold?
Yeah, the gold bug case leads heavily on that store of value inflation hedge argument. And that's based on two characteristics: scarcity and security. Gold is relatively scarce across the globe. The World Gold Council estimates that nearly 200,000 tons of above ground gold exist in the world, and two-thirds of that has been mined since 1950. Just to get a sense of how much that is, it sounds like a lot, 200,000 tons, but all gold ever mined would fit on a football field, piled less than 10 feet high. So just think about that. All gold in the world on just one football field, less than 10 feet high. And when it's mined each year, that adds less than the thickness of a coat of paint to that total. So just that
Wow.
scarcity, yeah, it's crazy. And so just that scarcity kind of is why gold is seen as a store of value, because in a world where people are, the way people say that central banks are printed money to kind of help us through this global recession, people are looking for those kind of scarce physical assets. And that leads me to the security point. Gold's practically indestructible, and most of that mined gold's still here today in the form of jewelry, gold coins, and gold bars. So that supply is largely static. And just the fact that it's a global asset with central banks using their reserves just makes it a very secure asset to hold.
Okay, I mean I get that. I can see some of the appeal there of we're not creating a ton more gold. It's a finite amount. It's hard to get, but once you do, it's not going anywhere. Certainly feels different than the printing of central banks, if you will, or the you changing decimal places on a computer screen. Um, all right, what's the other side? What's the bear case? Like, why wouldn't I invest in gold?
Yeah, the gold bear case pretty much rests on the fact that it's not a cash generating asset. Warren Buffett's a notable gold bear. He sees gold. He thinks it has no inherent value and it just has a lack of usefulness. Jason Zweig, he actually calls gold a pet rock. It just sits there. He thinks. And so that's kind of the primary argument: is it's not a cash generating asset. It's not like equity, which have earnings and dividends, or a fixed income asset which has a yield and repays principal at the end. It's not real estate, which is physical asset, but it could provide rent income. So it's just not a productive asset in Bear's view. And then just in terms of it not being a safe haven, I mean, it's volatile. It's been through some very large drawdowns, even in kind of the late 70s, early 80s, when there was hyperinflation, which should be was an ideal time for gold to invest in gold. There were still drawdowns of over 10%, equity-like drawdowns. It was tough to hold through those times. And in 2008, gold fell along with the market for a while there, even though eventually it did help buffer through the recession. Um, it's not always the buffer it's made out to be. And even recently, we saw in March, gold fell over 10% within 8 days during the worst of March. We saw people selling all assets for cash. So it wasn't the safe haven people kind of rely on in that time.
Yeah, I'm gonna toss one more stat on top of that. It's one of
Mhm.
my favorite stats about gold. It's actually over the past 40 years, so just since the end of the 70s, which admittedly was an incredible run for gold in the 70s, but over the past 40 years, nonetheless, gold has actually underperformed money market funds, and it's, to your point, done so with massive amounts of volatility. Um,
Yeah,
so
that's a good point. Good point. It's that goes against the whole store of value argument, right? It can lose value over long periods and it can underperform. There's probably better alternatives over a long period of underperformance like that.
Let's get into specifics. We've talked a bit about gold having good runs, gold being volatile, and having some big drawdowns. So, Josh, what drives the price of gold and what's driving it today?
Well, like any traded commodity, supply and demand affect gold prices. Supply, as I mentioned, doesn't really fluctuate too much, even though the pandemic did slow mining this year. That hasn't had a major effect on price. And then demand has actually fallen. Overall demand has actually fallen year over year. Consumer demand for physical gold fell, especially in India and China. And typically that's over 80% of total demand for gold in the world, just for jewelry, gold bars, and coins. Um, a global recession and a loss of income among much of the populations in these developing countries, and then higher gold prices in the first place. Gold was already pretty high in terms of in historical terms. That just makes it less affordable for other populations. So overall, consumer demand was down.
Okay, so if demand is down, and now if I remember back to my economics courses, you know, rising demand leads to rising prices. So falling demand suggests that gold prices should be going down, but they've gone up this year. What's going on?
Yeah, good question. That's where you get into the ETFs. I mean, investment demand is driving flows into ETFs, which is really driving kind of the surge in gold price. And that just shows, even though ETFs are kind of less of a percentage of typical demand, price can be driven solely by narrative and flows into ETFs. And those flows are based on what I've talked about in terms of there's a low opportunity cost because interest rates are so low. Gold usually goes up when interest rates are low and even providing a negative real return. So sitting in cash is just not worth it, and people are looking for return elsewhere. And that speaks to kind of the whole Tina theme, which we've talked about in other podcasts and other communication. That there is no alternative theme that drives people from bonds into other assets, sometimes riskier assets like stocks. But then again, there's still that safe haven that people want. So they look at gold because they're afraid of financial market risk, just brought on by the pandemic, geopolitical concerns, the upcoming election, and then add on to that all those other factors in terms of inflation. Um, and I think the final factor that's driving gold price up is just technicals. As a tactical manager, I look at technicals a lot. We base our strategies on price momentum, and this is what I would use one more acronym: FOMO. That fear of missing out. People see something going up and they want to buy more of it, and crowds rush to buy this. That trade. So everyone's rushing to gold. So all this together is just creates an investment theme that drives flows into ETFs and drives up the price of gold further.
Yeah, the FOMO's theme, one thing that Dan and I have talked about in past podcasts, but
Hmm.
let's keep talking ETFs because they clearly are, the marginal dollar in gold, it seems, really dictating price, whether people are buying or selling ETFs. And ETFs have made it easier to buy gold, but what's the difference just between uh, a gold ETF and physical gold? And are there any other ways that we should consider investing in gold?
Yeah, so there's an important distinction to be made between gold ETFs and physical gold. Gold ETFs provide the exposure to the price of gold, but you don't actually hold the physical bars yourself. ETFs are accessible and liquid, so they're sufficient to gain exposure to the price of gold. But it's just important to note that they're not as safe and secure as physical bars. So if you're looking for that security that is one of those themes behind investing in gold, just know that ETFs, there's some risk still there. Um, then the other way to get gold would be physical gold in terms of actually trying to purchase those bars. You could obviously purchase jewelry if you want, but some people, I mean, I've seen commercials all over the TV recently, which just shows the kind of hype over it recently. You could see, coins and gold bars being advertised for safety. So that's another way you could hold them in. But the thing is to realize that you're always going to have some counterparty risk, which is just the fact that you rely on a bank to hold all this for you in a vault. There's fees associated with that. There's contracts to sign. Just understand that if you're afraid of the financial system collapsing, that kind of doomsday scenario, which we don't see, we're optimists and we trust the financial system. But if that's your reason for buying gold, just understand that there's still risk involved.
Yeah, I agree completely, Josh, particularly on the gold ETFs, as you said, easy for trading, and particularly useful for tactical strategy. But if you think you're owning a gold ETF because you might need to get your hands on that gold and spend it. Well, in that scenario, most of the gold bars are held over in London. It's going to be pretty difficult to expect there to be a system in place to get it to you when you're going to need to spend it in that doomsday scenario.
Yeah, and actually, I mean that's what happened in March, right? The doomsday scenario seemed to happen in the worst of March, and all travel was shut down because of the pandemic, and there was even an issue with people trading gold and the fact that they didn't know if they were going to be able to get it delivered. So, yeah, no, just to your point, you're still relying on kind of the global financial system and other counterparties to actually store and deliver your gold.
Yeah. All right, and there's one more way to buy gold, and actually there were some headlines around this with Warren Buffett and Berkshire Hathaway. I mean, the headlines were a bit lazy, saying Warren Buffett buys gold, when in actuality it was probably one of his lieutenants, and they were buying a gold miner. Um, so give me a little bit on kind of gold miner. How's that different from buying a gold ETF or the gold bar or coin?
Yeah, so this is one way to get exposure to gold, and you are investing in an actual company. So I do like that aspect of it. But understand, miners are still very risky. So if you're, again, to the point of security and safety, if you're looking for that, you wouldn't find it invested in a gold miner. They're very reliant on the actual price of gold. The cost of mining, of actually mining gold, can be pretty high. And so, just be very wary. This is not going to be a cash position. This is going to be a high risk equity position in your portfolio.
All right, great. So, Warren Buffett's got some capacity to take risk. Um,
Mhm.
he can handle drawdowns
Yeah,
pretty
exactly.
well.
Yep.
Um, Great. All right, Josh. I think we've covered a ton of ground. We've walked a long way on the yellow brick road here. Um, I think we need to try and sum up here, come down. Where do we stand on gold? What's our advice when it comes to investing in gold?
So our advice is first, just understand why you're buying. Are you buying because you want that store of value or inflation hedge? And ask yourself, what is the chance of really having inflation or significant inflation in coming years? We've had QE. We had QE after 2008, and this was part of the reason gold ran up in 2011. People were nervous of inflation, and it never materialized. And then to that point that I mentioned earlier about the conflicted themes, if economic growth causes inflation, then why would you want to sit in a safe haven at that time? Why not just own equities? So I think that's one takeaway is why not just own equities if you're worried of inflation? And if you're buying it against a depreciating dollar, to hedge against the depreciating dollar, I mean, I think in my view, and I think the firm's view, uh, the fears of the U.S. dollar being replaced as the world's reserve currency have just been, greatly exaggerated. I think it's, U.S. dollar is still seen as a global safe haven. There's always going to be, people rushing to buy cash during the worst of times, and so, we don't see gold being that buffer, or that buffer in your portfolio that you can rely on. And so, just in terms of a depreciating dollar against other currencies, you could own international and emerging markets just to benefit from that weakening dollar.
I agree, Josh. Those are some important questions to ask if you are considering buying gold. And within your answers, you mentioned that there's some other assets like equities that might be able to benefit from some of the things that could, help gold increase in price. So, at the end of the day, how do we at Advisor Investments think about gold as an investment and using it?
We use gold as a tactical tool, not a strategic investment, which just means, we use it in our tactical, quantitatively managed portfolios. So we view it as a kind of risky option within those portfolios, not necessarily a cash buffer, a cash like buffer. And that just means that we're able to get defensive and sell gold, hopefully towards the top or a peak like right now. And that's the way we look at it. We just don't think that FOMO, investing at the peak price like it is now, is a good long-term investment strategy. But it does help create momentum, which can benefit a tactical portfolio.
No, I think you're spot on with that tactical, not strategic. And although you're the quantitative manager here, I'm going to toss out one more stat to close up on here. And just focusing on the idea of holding gold strategically may not be the best way to really grow your wealth over time. So the Vanguard 500 Index Fund was launched in 1976. So if we compare a $10,000 investment made in Vanguard 500 Index to a $10,000 investment made in gold in 1976, we see a pretty big difference. That $10,000 in gold is worth $175,000 today. That sounds good, but your $10,000 investment in 500 index is now worth around $1 million. So again, I think it comes back to, are you a strategic investor looking to grow your portfolio over time? Or are you looking more tactically to try and take advantage of some price momentum, or as a bit of a diversifier in your portfolio?
Yeah, that's a great point.
Thank you, Josh, for joining me on this, walk by the third rail of investing in gold. It's got a long and prominent place in our history, and it's going to continue to. But again, at the end of the day, if I'm thinking about wealth creation, it's done by investing in stocks of companies that are growing their earnings and making our lives better day in, day out.
Yeah, thanks for having me, Jeff. This has been great.
All right, this has been Jeff DeMaso and Josh Jurbala from Advisor Investments, thanking you for listening to the Advisor You Can Talk To podcast. If you've enjoyed this conversation, please subscribe and review our show. You can check us out at advisorinvestments.com/podcasts. Your feedback really is always welcome. If you have any questions or topics that you'd like us to explore, please email us at info@advisorinvestments.com. As always, I'd like to thank Kaylee Steele and Ashlyn Melvin, our editors, for making this podcast a reality. And thank you for listening, and stay safe.